Good morning, ladies and gentlemen. Clueless A Trading Frank here. It's 8:30 a.m. on a gorgeous, beautiful Thursday. Skipping here, Wednesday morning. Quick, but very, very important, especially for focused and disciplined Clueless A traders and investors. Very important video cast, and let me get into it. First and foremost, stay calm. And I mean that. Stay calm. Spell it. CALM. Say it to yourself a couple of times. The world is not ending. We had a huge technical drawdown which reached levels which were shown to all of you. And the measured move down was also shown, just in case we slipped below this line here of 1978. Okay, it didn't get there. We didn't get to that 1950 level that I projected we would get to. At this point, the 1950, which would be the breakout retest of the humongous breakout from late February of 2016. Many of you might have forgotten that this massive dragon bullish formation after the monstrous crash in January. That retest of that breakout level, for now at least, okay, from what I can see, is off the table. Okay, is off the table. So we have to go with what's in front of us. We have to be somewhat predictive, and most importantly, we have to be very disciplined, and I mean that. Okay, take it as a very strong suggestion. Stop being frigging emotional all the time. I say that to myself every single second of the day. So you guys should be really hammering your heads on the wall and telling yourself the same thing. Because some of you, unfortunately, never change the worst behavioral traits which exclude you from participating on any type of large gain, upwards or downwards. That's all I have to say. I'm here to help, but I will tell you that a lot of you need to wake up, smell the coffee, stop being always in panic mode. Stay scared. Stay somewhat panicked. Stay somewhat cautious. That's fine. That's all positive. But staying in constant panic mode, missing out on every single trade that's coming along the way, whether it be an IPO given at 20 some dollars and it hit 45. I'm sorry, hit 35 within a matter of 6 trading days. Whether it be a fast-moving stock like a BSPM, which goes up 50% in one day, and it's happened a few times. Whether it be Amazon calls, which are up 250%. I don't want to get into it, okay? The reason I don't put a real performance table out there in between the losses and the gains, because honestly speaking, it's going to make a lot of you feel like crap. It's going to make me feel like crap sometimes, okay? We had puts as hedges, okay, going into Tuesday, because it looked like we could test the 1950 level. They got blown out of the water. But all the longs that were long to play there, whether it be Goldman Sachs, whether it be Amazon, whether it be other plays that we were long on, paid the bills handsomely. Net was a decent positive day. Would have been an obscene positive day if those hedges weren't in place. But that's trading. So let's get into this here. Another reminder, and a serious one, okay? All day long, in between my extremely busy schedule of my own, trying to make a few pennies on my own to pay the bills, pay back loans, okay? I put out Periscope broadcast, even did a short video cast. Not to mention precision charts that are out there for people to follow. Not to mention comments and quick analysis that I put in the chat room and on the Twitter feed. So respect it. Okay? This engagement, in my opinion, for a lot of you who are maybe not as savvy as the market and as tuned with the market. No one's really tuned with the market. I mean, was Brexit tuned with the market? So the fact is that they, for a lot of you, it's invaluable learning experience. It's real-time learning for a puny 60, $80 a month. That's all I gotta say. Let me just get straight into the technicals here. So what I'm watching very carefully on a swing side, okay, and the swings work fantastic when it comes to the indices, whether it be the S&P 2000, S&P 500, SPX calls, or puts, and or the RUT. Those are the two ones that I specialize in. Remember, you don't need to be a jack of all trades, master of none. All you need is 1 to 3 instruments that take you to where you need to go. Okay, trying to spread your wealth out in 50 different things and putting all kinds of complicated strategies, honestly speaking, is going to make it's first of all, it's going to be taxing on your brain, and more importantly, you won't be able to track it, especially in volatile markets. So just keep it simple. On the daily side, this is what I'm looking at, and I've shown this before yesterday too, so I'll show it again. So you look at this, you look to see what's happening here, okay, underneath the surface. And the bottom line is that 1 second, let me get the drawing tool. I don't have the other drawing tool with me. I don't know why. So you have a double bottom, and this is powerful. You have a double bottom stochastic reversal. So best case scenario is that we get overbought at, let's say, 103 or so. At that point, the market is going to retest the underbelly of where we broke down from, which is the 50, well, where we crossed through, which is the 34 and the 50-day moving average, which, by the way, are starting to, as far as I can see, I got to look at this. I got to zoom in a second. Is still not completely collapsing. It's starting to top, in my opinion, but I don't see a trend down yet. Okay, you need to see a trend down on these lines to convince yourself and to predict that we are on a multi-month bear trend. We don't know yet. Okay, we don't know yet. So let's go by what we have in front of us. So this is great. So best case scenario, we retest the back end of the 34 and the 50, which is around 2070 on the E-minis, roughly 2075 on the S&P 500. Just track the futures because they're far more accurate. SPX is fine too, but futures are far more accurate. I've mentioned that 100 times. So that's the best case scenario. The moderate scenario was that we get towards these levels here, right there. 1 second. Okay, and that is roughly around 2053. Where it looks, I mean, just use common sense. It looks like we're heading to today. Okay, we are above, which is positive. This yellow line is your 5 SMA, very important. We're above that. Slightly, we're above that. Don't be surprised if we pull back below that too, right after the open as profit takers come in. But what I'm looking at is this zone here between 2050 to 2065. Now, some of you who are new and listening to this might be wondering, why is he talking about the minis? I'm much more concerned about my stocks going higher. Well, like they say in New York, hey, dude, stocks don't go higher if the markets, especially the S&P 500, is not cooperating. Yeah, you might have a BSPM type of stock that we trade quite often, which goes up 50% on the day markets are crashing. Okay, or you could have a Sarepta which gets bought out and whatever the case may be. But I'm talking about stocks that are daily bread and butter, the 10, 15, $20 movers, okay? The price lines, which is up 13 and a half right now. The Amazons up 5 right now. The Teslas up 3 right now. Okay? That type of stuff. So that's why these are so important, all right? Just get straight to the point. So that's what I'm looking at. Now this continuation on the daily needs not, if it starts to turn down, all bets are off. We're going to come down, test the lower end of the Bollinger at 2006, and possibly retest the lows again. That's only if I start to see this breaking down. Let's take a look at, because stochastics are important. What the other thing I'd like to see on this move up, and this is certainly a short covering move, it doesn't look like a bear flag anymore. It looks like a reversal. A 50% reversal brings us to around that 2060 level, 50% Fibonacci retracement. Is I like to see the volume spike here get larger, which would be nice. These are capitulation volumes. You can see that every single time. When the market bottomed back on the 20th of January, look at the size of the volume candle here. Look where we went. We actually went above that. Okay, so when you get this type of capitulation selling, there's a bit of a relief rally. This is a relief rally. Okay, another craps out of Europe. What the EU says, another, no offense, but idiotic British politician does what they're doing. We're gonna fall. Very dependent on the British pound. Track that index too, and I showed that where to look at it. Okay, the J, what do you call it? The G BP slash USD on Thinkorswim. So this is cooperating on the daily basis. For swing traders, that's fine. You're starting to see the green line move up too, which is good. We'd like to see some more of a volume confirmation, volume going over, volume moving higher. And let's take a look at the McClellan oscillator. Oh boy. One second here. I'm looking at the daily as a more of a swing picture. So the McClellan oscillator is at this point trying to go positive. Probably goes positive today. Who knows? I don't know. All I know that things that I bought 2 days ago are very profitable. So that's how a trader should think. So the McClellan oscillator needs to go positive. If we go positive and we get up towards these levels of 92 or so, markets are overbought. By that time, we should be on the upper end of this channel, which I have drawn very precisely, and that would be around the 2070 level. If we break out of this, that's a different story. That means there's a bit of a trend reversal. But I think this is massive resistance right here at around the 2065, 2069, 2070 level on the E-minis. All right. So that's one chart. The next one is the one that I showed quite a bit. In fact, actually, I can show it on this one too. Is a shorter term bear flag stuff, which is very important. Very important that people try to, as I like to say, educate themselves a little bit, right? Try to educate yourself, because only then no one will make you successful in this business. Nobody, not me, not any other guru, not anyone. I'm certainly not a guru. Okay, but I'm definitely a passionate learner of life, trading, and everything that has to do with finance. So it's you who's going to make yourself reach that promised land that you always want to get to. That's what I tell myself. So what we had here on the 15-minute was this bear flag. It's broken. It's broken. The bear flag's broken out. So I had drawn this, and yesterday I thought I had drawn it here, but I can do this again. And these are simple things here. You don't need to be a rocket scientist. You don't need to look at wave 3 and Elliott wave and all that stuff, which is all fine and good. But I don't have time for it. I read them, I understand them, but am I going to go out there and draw all those fancy, things all over the place? No, because it doesn't do anything for me. So right now we're in this upward channel. We were in this channel yesterday, and the bear flag basically broke out. Look at my charts, videocast, periscopes that I did for all your benefit all day yesterday. All right. So let me do this again. So once this bear flag is broken, it's heading towards the levels that I have shown. Now here was a major supply point at 2065. So I wouldn't bet anything, I wouldn't stay long above 2065, because there's going to be a lot of selling here if we get there. Along the way, there's 2050 and 2060. But right here, okay, you got a lot of selling, because this is where people got ambushed, right? Now remember, I would say a good 90% of things that I read, they're extremely bearish, which is fine, because there's a fundamental reason to be bearish. There's Brexit stuff. Don't take it lightly. I mean, it's serious stuff. But the point is that technically speaking, bearishness equals massive amounts of shorts who need to cover. So any type of slightly less bad news coming out of Europe, any type of firming of the British pound and the Japanese yen softening, the British pound firming, is going to spark off massive short covering rallies. And this is nothing but a short covering rally. I'm sure there are buyers in there too. Smart money bought lows. Why wouldn't they? There were stocks which were down humongous. Stocks like Goldman Sachs which are exposed to Europe and Asia and stuff, global banks, they were down 7% in one day, unheard of. So anyway, so this bear flag looks like it broke out now, and you can see what's going on. And I also drew the bullish expansion candle on the daily. And let me show you a quick right there. Let me get these lines out. So that's a bullish expansion candle. Let me zoom in. There you go. That's a bullish engulfing candle expansion. Very, very powerful. Yes, there resistance along the way, but a back test of the 34 moving average at 2072 very likely by Friday. Remember, holiday weekends, extremely important for the economy and for whatever reason. I mean, that's the main reason, okay? They prop up the markets, the so-called PPT, plunge protection team, Google it. They prop up the market and bring it up there. They don't want people going into a beautiful July 4th, Independence Day celebration, shopping. U.S. consumer confidence is strong with a broken heart that we're down 700 points. Okay? So we don't expect another crash unless something really dramatic happens in Europe, Asia, or somewhere else. Now, one other thing that I want to mention to you from a psychological standpoint is this. When markets bottom, let's say when it was down here at 1800, all right? There were no buyers. We were scalping. We saw the reversal candle. We scalped. Anytime you see a large expansion candle like this, and I showed this yesterday, okay? It's normally a 3-day follow through. 1, 2, 3. Yesterday was the first day. Right now it's the second day. 3-day goes into tomorrow, okay? Tomorrow going into Friday. That's the third day. All right. After 3-day follow through, there's a consolidation. And after that, we see what happens. Will that consolidation pull us down, back to testing this channel? The channels are important. I've drawn them for your benefit. Okay? Or are we going to take this out? In which case, we're back to the nice 1980s. At that, if we hit another thing here, either it's going to be a dragon bullish formation like this, W, or it's going to hit my 1950 mark down here. Down here. All right? So we'll see. If we break out over this line, I mean, it's hard for me to think that might happen this quickly after the technical damage that's been done. But then we're back testing 2118, the highs again. Is it crazy? Believe me, it felt crazy here that the markets could rally from these levels. The last thing I'll tell you, I got 2 minutes, is people who have the mental fortitude to buy something at these lows and follow the internals, follow some of the simpler things that I'm showing you, and let's say follow this thing all the way up here if it gets up there. Okay, that's the unknown. We don't know, and volatility keeps us from doing that. But anyway, let's say you put a small amount of money out here, and this market does what I'm thinking it might do. Okay, that's a probability game. That's a lot of return. A $10,000 invested down here was roughly $200,000 here. And I'm not kidding, $170,000 to $200,000. Did we hold it in a straight line up? No, because we had a lot of unknowns along the way. But just letting you know that if somebody wants to exercise that patience, that discipline, and the mental fortitude, and the risk capital, they could also get 1,500 to 2,000% type of returns. Thank you for listening.